Okay. So we come to basics of options. So in terms of options, right, now we did forwards, futures, swaps. Forwards are what? Forwards were an obligation between two parties. One party agreed to buy the underlying asset at a certain price, certain date, pre-agreed price, pre-agreed date in the future, while the other party agreed to sell the underlying asset, a specified price, specified future date, right? Specified quantity. These were agreements, these were obligations between two parties. That was forwards. Futures was the exact same thing, only difference was it was exchange traded. Swaps, again, a series of forward contracts with multiple forwards occurring. Options are slightly different. It is an iteration of a forward. Iteration of a forward meaning an option is where one party agrees, not agrees, one party takes the option, has the option to buy or sell the underlying asset at a pre-specified price or a pre-specified future date. Okay? To buy or sell the underlying asset at a pre-specified price or a pre-specified future date, but this party has the option. So, option or right. An options contract is where it gives the holder of the option the right to buy or sell the underlying asset on a certain date at a certain price. So in options terminology, we have a few terms that we use. So for example, the person, if one party has the option to buy something, the other party always has the obligation to sell it. If one party has the option to sell something, the other party always has the obligation to buy it. So in an options contract, there are two parties where one party always has the option, and the other party, or let's call it the right, and the other party has the obligation. So one party has a right or an option, while the other party has an obligation to do the exact opposite side of the transaction. Can I ask, why do both parties not have the right or the option to buy or sell the asset, the underlying asset? Why do both parties not have the right or obligation to buy or sell the underlying asset?
Then they will never transact.
They will never transact. Yes. Because always options are also zero-sum games. One party will always win, the other party will always lose. But here, the person who has the right will always win. The person who has the obligation will always lose, right? On a payoff basis, we'll talk about it a little bit more. But the person who has the right will be the party who will exercise the option in case it's advantageous to them. If it is not advantageous to them, they will not exercise it. So if you remember the futures contracts, in futures contracts, we spoke about how at expiry of the contract, you can either this is what the long side of the equation looks like, and this is what the short side of the equation looks like, based on your futures price or exercise price, right? So the long, in a futures contract, the long will have points where it's favorable for him to exercise, but he is obligated whether it is favorable or not. Versus in an option, if it is not favorable, you will not exercise the option. You will just let it be. You will not exercise the option. If it is not favorable, you will not exercise the option. So if both sides have the option, when the long is positive, the short is negative. When the long is negative, the short is positive. Right? If both sides had the option, when the long is positive, he wants to exercise the option. The short will say, no, I am making a loss. I don't want to do this. Okay? And when the long doesn't want to do it because he's negative, the short will say, no, I want to do it because I am positive. That is why both sides don't have options. Both sides don't have the option or the right to do something. One party, we call that party the holder of the option. So in options contracts, you have two types of parties. You have what we call the holder of the option, the holder of the option, and the writer of the option writer. The holder of the option and the writer of the option. The holder of the option has the right to buy something or sell something, while the writer has the obligation to do the opposite side of the transaction. Where the holder has the right to buy the underlying asset, the holder has the right to buy the underlying asset. The right of the obligation has the obligation to sell the underlying asset. Where the holder of the option has the right to sell the underlying asset, the right of the option has the obligation to buy it. So these types of options have specific names attached to them. When the holder wants to buy the underlying asset, we call it a call option. Call option. When the holder wants to sell the underlying asset, we call it a put option. Put option. So you have the right to buy an underlying asset, that's a call option. You have the right to sell the underlying asset, it is a put option. So no longer will we use the terminology long short. Now we're looking at the holder, the writer, call options, put options. Do you want to buy the underlying asset in the future, or do you want to sell the underlying asset in the future? If you have a call option, the holder has the right to buy, but the writer has the obligation to sell. If it's a put option, the holder has the right to sell, but the writer must buy, has the obligation to buy. Why would he do this? Why would the writer do this? Why would he take on obligation if he's always going to be negative? I mean, the holder will only exercise the option if it's positive for him. And if it's a zero-sum game, that means that it's negative for the writer. Why would he do that? Yep. Why would you give another person the right and take on a bad outcome yourself? The probability of a bad outcome. Charge a fee for that. Exactly. You charge a fee for that. We call this the option premium. Just give me 1 second. Right. The option premium. So he will charge for taking on this obligation. He will charge an upfront fee. And we call this the option premium. So sometimes we call it the option price. The call option price, the put option price. Any questions here? Okay, seems straightforward, right? So the buyer of the call option, meaning the holder of the call option, has the right to buy the underlying asset, while the seller has the obligation to sell it. The buyer of the put option or the holder of the put option has the right to sell the underlying asset. Therefore, the writer is obligated to buy it. And the writer will charge a fee, which is called the option premium. So when you talk about an options contract, there are certain things that you specify. So, for example, is this a call option or a put option? Is it the right to buy or the right to sell? What is the quantity? What is the underlying asset? What is the exercise price? So here in options, we call it the exercise price or the strike price. Both terminologies used, exercise price or the strike price. That is the price that you pre-agree to do something in the future. What is the price that you agree to buy this asset or sell this asset in the future? This is what we call the exercise price. We use this terminology even when we talked about forwards and futures, right? And is it physical settlement, net settlement? How is the settlement going to happen? Most of these, again, options are typically OTC, but there are certain options that get traded, exchange traded. Like, for example, last time you saw a lot of those commodity options, a lot of those, what do you call it? Futures. Futures that we were talking about last week. You saw each and every one of them had an option attached to it. So I'll show you that again later on. But so you have options that are exchange traded. You have options that are exchange traded. But you can have OTC options as well. So in options, you have to decide or you have to specify. Is this option a European option, American option, or Bermudan option? European options are the more typical type of options. Now, this means European option means the option is exercised at the end of the period. So you go back to my car example, right? Like what we were using last week. So we have a car. I want to buy the car from you. And when we talked about forwards, we said, we agree to buy the car at 5 million rupees. I am obligated to buy the car at 5 million rupees in 3 months' time. You are obligated to sell the car at 5 million rupees in 3 months' time. In an option, if I had a call option, I take the right to buy the car in 3 months' time. So in 3 months come, I will check. After 3 months, I will check. What is the market price? If the market price is 6 million, I am better off, right? I have a contract where I have the right to buy the car at 5 million. If market prices are 6 million, I will buy it. I will exercise my option. You are obligated to sell it. So in this situation, I am the holder of the option. I have the right to buy the car, the underlying asset, in 3 months' time, the time period to expiration, the term to expiration of the option, at 5 million rupees exercise price. In 3 months' time, after 3 months, I check what the market prices are. If I can't exercise the car before the end of the 3 months, the right to buy before the end of the 3 months, this is called a European option. European option. For European options, you have to wait until the exercise date to check what is happening with the market and then figure out, are we going to exercise this option or not? If market prices are 6 million, I will exercise my right to buy the car at 5 million. And you, the seller, the writer of the option, must sell me the car for 5 million rupees. So you will make a loss, I will make a gain, a hypothetical loss, hypothetical gain, right? Because market prices which is the spot prices in the market at time of expiry, it's 6 million. I make a hypothetical gain of 1 million, hypothetical meaning an opportunity gain of 1 million. I'm buying it at 5 when I might have had to buy it at 6. I'm better off by 1 million, which is why I'm exercising my right to buy. You are making a loss of 1 million. But because of that, I pay you something upfront. Now, that's never happened in forward contracts. Forward contracts, you and I got into an agreement. I'm going to buy the car from you in 3 months' time. You're going to sell the car to me in 3 months' time, no matter the market price. It's an obligation. And we didn't have any money that we kept upfront, nothing. With futures, there was a deposit that was required. It was a deposit. It was not a fee. It was a deposit that was required to be kept, the initial margin that was required to be kept upfront, right? Even in forwards, if you're doing the forward with a dealer, they might ask for you to keep an initial margin. But with options, you pay a fee. You pay a fee to get the right to buy the car. So if I paid you 500,000 rupees and say, I want to have the option to buy the car in 3 months' time, a European option, because in 3 months' time, I will check, not before that. And for the European option, I'm paying you 500,000 upfront today, and you, the writer, will receive that fee. So when we look at your profit in 3 months' time, if, for example, market prices are 6 million, you have opportunity loss of 1 million because you have obligated to sell me the car at 5 million. But you've made that 500,000 early. Now, in 3 months' time, if market prices of the car is 4 million, will I buy the car? If market prices of the car is 4 million, will I buy it? Will I exercise my right to buy it? No, right? I will not exercise my right to buy the vehicle. I will not buy it. I'll let the option expire worthless. That 500,000 has been paid up front. Tough luck. That was for me to have the right to do that. No? So I lose that 500,000 that I paid up front. You have that 500,000 that I paid up front, but we don't do a transaction. There is no transaction that happens at the end of the period. And therefore, the option expires worthless. And you, the writer, are now up on the deal by 500,000 because I gave you 500,000 at the beginning of the option contract. So European options, which are the most common type of options, has exercise at the end of the period. American options, you can exercise anytime, right? From today till expiry of the contract, anytime I can decide to buy the car or not. Within the next 3 months, anytime before the end of the contract, I can decide whether to buy the car or not. So if market prices are 6 million, 7 million, I'll decide I'll buy the car today. But if it is not, I'll wait, and I have time to wait until the end of the contract where I have to make my final decision. So American options can be exercised at any time before maturity. Anytime before maturity. Bermudan options are a hybrid. Bermudan options are a hybrid between European and American. It is where you pre-specify dates. Let's say, for example, over the next 3 months, every 15th and 30th of the month, I will decide whether I want to exercise the option or not. So every 15th of the month or 30th of the month, I take a call on, do I want to buy this car or not, depending on market prices. So I have 6 points which I can exercise before the end of the maturity period of the option in my example. Right? Every 15th of the first month, 30th of the first month, 15th of the second month, 30th of the second month, and so on. I have 6 points which I can exercise before the maturity of the option. That's what we mean by a Bermudan option. Questions? Okay.
The option, you talk about the option from the point of view of the holder.
The holder, always the holder. Yes. So call options, put options, everything is from the point of view of the holder. Okay.
Madam, here how the both parties are meet from a dealer or that intermediate is there, or how
How do they know each other?
Yes.
So usually options are, so you will have exchange traded options, in which case it's or on an exchange. If it's over the counter, it's highly likely it'll be a bank or a dealer. But actually, a lot of options are exchange traded. There are a lot of options that are exchange traded. You have a few options that will be you can do over the counter customized options, for which, like you're asking, it will be a bank or a dealer.
Noted.
Okay. So here you can see some examples of exchange traded versus over the counter options. So stock options, commodities, index options, all of these are some examples of exchange traded options versus, I mean, interest rate options on interest rates. Now even those are available exchange traded as well. Cross rate currency options, and then we have swaptions. Swaptions means options on swaps. So you have swaps and you have options whether to execute the swap or not. Swaptions, these are some customizable transactions. So in options, you always check, are you in the money, out of the money, or at the money? In the money, out of the money, or at the money. Now remember, oh no, I won't show the diagram. Let's draw the diagram. Okay. What does that mean? In the money, out of the money, or at the money? In the money means this option is profitable to exercise. So in my vehicle example, we agreed to buy a vehicle in 3 months' time, European option. I want the right to buy the vehicle in 3 months' time. So I say I get into an option with you where I am the holder of the option, you are the right of the option, and I have the right to buy the vehicle in 3 months' time. If market prices are 6 million, I am in the money because I have the right to buy the vehicle at 5 million. It is profitable for me to exercise this option. I am positive on a payoff standpoint. Versus if market prices are 4 million, I'm out of the money. I'm out of the money. It is not profitable for me to exercise this option because I can buy it in the market for 4 million. Why do I need to buy it from you at 5 million? It is not profitable for me to exercise this transaction. Out of the money. At the money is exactly at 5 million. If market prices are 5 million and I have the right to buy from you at 5 million, I'm agnostic. It doesn't matter to me. I'm neutral. It doesn't matter to me whether I buy it from the market or buy it from you. So in the money where it's profitable to exercise the option, out of the money where it is not profitable to exercise the option, and at the money where you are neutral, where the market prices are equal to the exercise prices. Same thing for the put option as well. Now, this was a call option where I had the right to buy the underlying. Let's talk about a put option. In a put option, you have the right to sell the underlying. So in my car example, let's say I want to buy the car, you want to sell the car, but this time you take the option. You take the option and say, you have the right to sell the car to me in 3 months' time. You have the right to sell the car to me in 3 months' time. Therefore, in 3 months' time, if you want to sell the car to me, I am obligated to buy. I am obligated to buy. I am the right of the option. You are the holder. You have the right to sell, but you are the holder of the option. Holder of the option. And for that to get that privilege, that right to sell the car to me in 3 months' time, you pay me upfront. You pay me that money and say, don't give the car to anybody else for the next 3 months. I'm giving you upfront and paying you the fee upfront, but I will decide in 3 months' time if I want to sell it or not. So it's not don't give the car, it's don't buy a car from anybody else for the next 3 months. But in 3 months' time, I will decide whether you're going to sell the car or not. So in 3 months' time, if vehicle prices are 6 million rupees, you have the right to sell to me at 5 million rupees. 5 million rupees. Now, is the option in the money, out of the money, or at the money?
Out of the money.
It's out. It's out of the money. Vehicle prices are 6 million. Why would you want to sell it to me at 5 million? You can go to the market and sell it at 6 million. It's out of the money. So therefore, the option will not be exercised. I will keep my 500,000 rupees that you gave me, right? But the option will not be exercised. If vehicle prices are 4 million, you have the right to sell to me at 5 million. You don't have to go to the market and sell it at 4 million. I am obligated to buy it from you at 5 million. You are in the money. So always in the money, out of the money is on the side of the holder of the option. Okay. The writer is simply a resultant. We never look at the writer's side unless as a resultant. Okay. So the writer has no choice. He is simply a resultant of the holder's decisions, always. Resultant of the holder's decisions. Okay. Keep that in mind when you're doing like the next set of diagrams and all that. So the writer does not make any decisions at all. So on the writer's side, you are, when vehicle prices are 4 million, you are in the money. You have now the option to sell it to me at 5 million, although vehicle prices in the market are 4. You are better off. So you sell it to me at 5, I am obligated to buy it from you at 5 million. Okay. So that's the in the money, out of the money, and at the money of a put option also is where vehicle prices, it doesn't matter to you because market prices and the exercise price is the same. Any questions? Okay. So,
Madam, how that car fee is computed?
how is what computed?
The fee.
The fee. I'll come to that tomorrow.
Sure.
We're not going to do any computations, but the fee is a little bit of a complicated thing, and I will refer to it tomorrow in terms of how we come about it.
Okay.
Okay. Okay. So let's look at an example. So here, if you remember last week when we did futures, we talked about the fact that in futures, there is no difference between what we call payoff and what we call profit, right? So now in options contracts, there really is a difference between what we call payoff and what we call profit. What we mean by payoff, okay? What we mean by payoff versus profit. Payoff is the transaction's opportunity costs or opportunity gains at the end of the transaction period, at maturity or at exercise. It's not necessarily at maturity because it's at the exercise date because of the American options and Bermudian options, right? If it's European options, it's always at maturity. But if it is for American options, it's at some exercise date that you're checking it. If it's for Bermudian options, it is on the exercise dates that you're checking it. But payoff is on that exercise date is your what is the opportunity gain or opportunity loss from the contract at maturity, right? At maturity or at exercise date, depending on the type of contract. Profit is when you take the entire cash flows into consideration, including the beginning, cash flows received at the beginning of the contract. So once you take that fee also into account, then the total cash flows is profit. Okay? So payoff is end cash flows. It's not cash flows because it's opportunity costs or opportunity gains. Profit is opportunity costs or opportunity gains plus the cash flows that you receive at the beginning of the period. Now, which is why there is no concept of profit and payoff in forwards and futures. What you keep as a margin is a deposit. It's not a fee, right? Deposit is simply an advance payment of something that you're going to do in the future. So it's not a fee, it's not a cash flow. But here in options, you actually pay a fee to get the right. So because of that, there is a distinction between payoff and profit. So let's look at the payoff first. What does this diagram look like? If you remember, in futures and forwards both, the long diagram look like that, and the short diagram look like that. For the price of the underlying asset, which prevailed at maturity, okay, spot price at time T maturity, versus the profit. Okay. There's no difference between payoff and profit. Now, this is for the long, this is for the short. Now we don't have technically what we call long and short, right? I don't want to use that terminology. You can use it, but let's use holder and right. So try, what is the payoff for the hold of the call option? So 60, 70, 80 are the scenarios that can happen when the contract expires in the future. So just do the payoff, don't do the profit at the moment. How do you think this diagram should look like? First and foremost, is this a call option and a put option? Call or a put? Because, not because it's there in the graph, but because it is the option to buy oil, right? Enters into a long position for the option to buy oil. It is long position means you're the holder, you're buying the option to buy oil. Buying the option to buy oil. So, as the holder of the option to buy oil, you have the option to buy oil, meaning you're in a call option. You have a call option at exercise price of 70. Now, and you're paying a premium of $5. Premium option premium is the fee that you pay. So, what is the payoff? If you're the call option holder, what is the payoff? Let's look at 80. If market prices at maturity of the option, if market prices are $80, are you in the money, out of the money, or at the money? Is it profitable to exercise the option or not?
In the money.
You're in the money. You have the right to buy oil at 70. Market prices are 80. You are better off by $10, right? Yeah, Neeraj, correct. Profit is not correct. Payoff is correct. Profit, there's a small error. One part has an error. Just check on that. Okay, so you're better off by $10. Okay. Why better off by $10 per barrel? Because you have the right to buy it at 70 when market prices are 80. So you're better off by 10 barrels. At 75, you're better off by $5 US dollars per barrel. At 70, are you in the money, out of the money, or at the money? At 70.
So do you look at it before premium or after?
Okay, good question. That's why we said payoff, right? Payoff is at the expiry of the transaction or at the time of the cash flows or the opportunity costs or gains at the time of execution of the transaction, which for European options are the expiry of the transaction. For American options, it can be some in between period. But it is at the end, at the time you're exercising the transaction. Only the cash flows or opportunity costs or gains at that point in time is what you look at. Profit is once you take into account the total transactions, including the fees. So here, is it with the fees or without the fees?
Without.
Yeah. Payoff is without the fees. Profit is with the fees. In the money, out of the money, at the money, you always take on payoff, not on profit. Because what we say is your decision to exercise the transaction or not is based on not on the fees that you paid. That's sunk cost. It was 3 months ago. In my car example, I paid that 500,000 to you 3 months ago. Today I'm looking at my market prices are 6 million. I can buy the car from you at 5 million. That's my payoff. But when I look at my overall transaction, I'm not 1 million in gains because market prices are 6 million and I'm buying the car from you at 5 million. I have an opportunity gain of 1 million, which is my payoff. But when I look at the overall transaction, I'm not 1 million in gains. I paid you a fee of 500,000. So actually my profit is 1 million minus 500,000, 500,000. That's the difference between payoff and profit. Okay. So at 80, I'm better off by 10. The holder of the option is better off by $10 per barrel. At 70, in the money, out of the money, or at the money? At the money. He's at the money. There is no gain, no loss for him to exercise this option. And no gain, no loss. Market prices are 70. He can buy in the market at 70, or he can exercise the option and buy from this seller at 70. Is no gain, no loss, right? Between 70 and 80, you should see that it is a straight line. And above 80 also, it is a straight line. Because at 75, he's in the money by $5. At 85, he's in the money by $15. So it increases in equal increments. It is a straight line. At 60, is he in the money, out of the money, or at the money? He's out of the money. Yes. What will he do? Or what is his payoff? Positive, negative? What is his payoff? Zero. Yes. And that's very important to understand for the others as well. I hope you understand his payoff is not negative 10. His payoff is zero. Why is that? Why is that? That's the reason. Market prices are 60. He has the right to buy it at 70. In a futures contract or a forward contract, he would have been obligated to buy it at 70. Therefore, when prices were 60, he would be making a loss. Right? When prices are 80, he would be making a profit. But when prices are 60, he would be making a loss. Okay. But here, he has the choice. That's why he paid you upfront. He has the choice. He's the holder of the option and he will not exercise his right. He will let it expire worthless. Zero. Right? So when market prices are 60 and he has the right to buy it from you at 70, he said, no, I don't want to buy from you at 70. I'll go to the market and buy it at 60. So my option contract with you doesn't get executed. So anything below 70, when I am out of the money at 69, at 68, at 65, at 60, at 10, anytime, this options contract expires worthless. It expires worthless. Okay. So it remains at zero. So this is what the payoff for a call option looks like. This is when you're in the money. This is when you're at the money and out of the money. Look at the difference between the long position of a forward contract or futures contract versus the holder of a call option. When it is positive, both have the same graph. When it is negative, actually the profit or payoff for the long is negative in a futures contract or a forward contract, but not in an options contract. In an options contract, the option is not exercised and therefore expires worthless. Any questions here? Niraj now is correct. Any questions? Okay, now draw the profit diagram. The same diagram, how will the profit look like? If you look at the call option holder, what is his profit from the transaction? Shape of the graph is right, Niraj, but no, that's good. So what does your profit diagram look like? What's the difference between payoff and profit? Profit is simply the payoff minus the option price, option premium. I'll just write it as fee here, but the option premium or option price. That's profit. The fee or the option price or option premium that you pay at the beginning of the contract. That's it. So the profit is simply a derivation from payoff. Once you know the payoff, you know the profit. So, for example, here you had a $10 payoff. Now, what will your payoff be at 80? Your payoff will be $10 minus the $5 fees that you paid per barrel. So it will be 5. Right. At 70, your payoff will be negative 5. At 60, your payoff will be negative 5. At 10, it will be negative 5. At 65, it will be negative 5. It will be -5 below 70. -5 below 70. And then at 80, it will be 5. And it will keep on increasing to 5 and move up from there. So at what point does it cross? What point does it start to break even? At 75, right? Okay. So that's the profit for a long call. So it's the same payoff diagram, but now it has reduced because the profitability has reduced because of the fee that you have paid. Can you draw the payoff for a short call option? Draw the payoff for a short call. Essentially, the right of a call option. You are selling the right to buy, meaning you are the writer of the call option. Right of the call option. Payoff diagram first. Yes, Niraj, correct. So, what does this look like? Payoff, right? Now we're talking about payoff without the fee. At 60, what is the payoff? Or, sorry, let's take it for 80. At 80, what is the payoff for the option writer? What is the payoff for the option writer at 80? Positive, negative, zero, what is it? What is it? Explain to me what the writer is. Who is the writer of the option, of the call option?
Party that has the obligation.
The party that has the obligation to
To sell.
So the writer of the call option is the party that has the obligation to sell the asset. Now, you have the obligation to sell the asset at 70. Sell oil at 70. Obligation to sell oil at 70. Market prices of oil at expiry of the contract are 80. What is the payoff? Yes. It is a mirror image of the caller. Yes. I hope you're correct. I hope you all understand that when you talk about the payoff for the writer of the option, at 80, he's losing money. At 80, he's losing money. He is losing $10. Why is he losing $10? Because he is obligated to sell oil at 80. Sorry, at 70. If he could, he would have sold it in the market at 80. But he's obligated to sell it to you at 70. So he loses $10. Right? Because the holder of the option gains $10, the writer of the option loses $10. And when the holder of the option gains $5, the writer of the option loses $5. When the holder of the option is at the money, the writer of the option is also at the money. So his payoff diagram looks something like that. It keeps on going down. Higher the spot prices in the market, higher his loss. Yeah. At 60, he's better off. At 60, he's better off, right? Market prices are 60, he is obligated to sell it to you at 70. Isn't he better off? Yes or no? Is it positive at 60? Is it positive at 60? Yes?
No.
Yes. It's zero. Yes, he is positive at 60, but the problem is he is positive, the holder is negative, and the holder is the one who makes the decision, right? The holder will decide not to exercise the option because he is negative. Because the holder decides not to exercise the option, although the writer is positive, he doesn't get the benefit because the option expires worthless. And therefore, for the writer, his payoff is 0 below the exercise price. Below the exercise price. So the writer's diagram always looks like this: 0 and negative. Writer's payoff diagram. The holder's payoff diagram is always 0 and positive. For a call option, the holder's payoff diagram is always 0 and positive. How much positive? It's the spot price in the market minus the exercise price, right? It's positive by that much. For the writer, the payoff diagram is always negative or 0. So it's 0 or it is minus of the profits that the holder is making. Not the profits, the payoffs that the holder is making. What does his profit diagram look like? Profit diagram? For the writer, what does the profit diagram look like? It is a mirror image where you have positive, you make a positive $5, right? Because you have received $5 from this transaction at the beginning. So you make a positive $5 as long as the option is not exercised. But from the time that the option can be exercised, your profit comes down. And actually, you start making losses from 75 upwards. So for a call option, your profit is the market price minus X minus the call option premium, or the call option premium minus call option premium, versus here, this profit is the call option premium or the negative plus the call option premium. Try the same thing. Look at what the graph looks like for the put option. So this is a put option. You have the option to sell oil. It's a put option. What does your payoff diagram look like for the holder of the put option and the writer of the put option?
Is in an option the long?
You're buying the
The
right to buy the put option. So that's a
the
holder.
holder is always long.
Sorry, I missed you. What?
The holder is always long, is it?
The whole day is always long, the option. He has the right to buy it. He's buying the right. Other way around, he's buying the right.
So the long short is from the point of view of the right.
Of the right, yes.
So for a put or call option, hold is always long.
For a put or a call option, hold is always wrong, and the long, and the right is always short. Yes, correct. So at 60, at 80, is he in the money, out of the money? The hold of the option, is he in the money, out of the money, or at the money? He's out of the money. I hope you understand that at 80, he has the right to sell at 70. But if market prices are 80, it's not profitable for him to sell it at 70 to you. He'd rather go to the market and sell it at 80. So he's out of the money on the contract. Therefore, he will not exercise the option, right? And the option will expire worthless. So the option will be worthless at 80. Yes, correct. Yep. At 70, at 70, he's at the money. He has the right to exercise the option at 70 and sell oil at 70. He can do it to you or to the market. It doesn't matter. He's neutral. He's at the money. At 60, He's in the money. At 60, he's in the money. He has the right to sell oil at 70. Market prices are 60. He's better off. He's better off. He can sell to you at 70. You have to buy it at 70. If he went to the market and he didn't have this contract, he'd have to sell it at 60. But because of this contract, he can sell it at 70. Therefore, he's better off by 10. So he's at the money. So below 70, he's actually at the money. And imagine market prices were zero. The hypothetical situation where market prices are zero, he is better off by $70 because you have to buy it at 70. So, sorry, this is supposed to be a straight line. Below 70, the exercise price, you will see the call option, put option diagram looks like that. Above 70, you are out of the money. So this is what your put option diagram will look like. At the money and in the money. But how will your profit diagram look like? How will your profit diagram look like? What will happen in your profit diagram? Is it confusing for you all? I just want to understand, is it confusion or you all understand too much and it's very easy and that's why not answering, or just want to know that you understand, right? Is it confusing or you understand? What would your profit diagram look like? At 70, it should be a $5 loss. Yes. At 80 also, it should be a $5 loss. Right. At 0, it should also be a $5 loss, but $5 loss from 70, right? So it should be 65. So always your profit is your payoff minus your fees. I call it fees. It is the option premium or option price. Okay. So let me just so this said these are supposed to be parallel, the black line and the red line are to be parallel to each other, right? Parallel to each other. Okay, at what point does it break even? Oh, sorry, what point does it start to make losses?
60.
Is it at 60? 65, yes. At 65 only, it starts to make losses. At 60, the profit is 10. Sorry, the payoff is 10. And the profit is 5. So what's the equation for this? If you look at for the payoff, when you're out of the money, anyway, your payoff is 0. But when you're in the money, your payoff is what? The 70 minus the market price, 70 minus 60, 70 minus 0, right? So that means your exercise price minus the market price. And what is your profit? Your profit is negative the put price or the fee, or where you're in the money, X minus ST minus the fee. So we finally finish off this put for the writer, and then we can call it a day. So we're completing that part. Can you quickly tell me how this would look like? Payoff and profit for the writer of the put. Yes. What do you think? What does the short look like? Right off the option. At 60, what does it look like? Payoff. Payoff at 60. He's the mirror opposite of the holder, right? So what does he look like? He goes down as much as negative 70. At 60, he's making a $10 loss. Why? Because he has agreed to buy, obligated to buy. When the holder has the right to sell, he has agreed to buy. So he's agreed to buy at 70. When market prices are 60, he's agreed to buy at 70. So he's making a $10 loss, opportunity loss. Opportunity loss. Yeah. And like this, anything below 70, he makes the opportunity loss. But above 70, he makes a gain. He's agreed to buy at 70. Market prices are 80. He would have made it. But he doesn't make the gain because he's the option, the holder says, no, I'm not going to exercise this option. I am out. Therefore, he doesn't make that gain the option expires worthless. Option expires worthless. So for a put option, this is what for a put option, this is what the right of the option looks like. Yeah. The right of the option looks like. And what does the profit look like? Profit from a put option is the fact that he got. So for him, for the right of the option, profit is the payoff plus the fee. Plus the fee. Because he receives it. So his loss comes down by the amount of the fee because he received the fee. Okay. So at 65, he starts to break even. At 70, he's made a $5 profit. And above 70, he keeps on, he gets to keep that $5 profit. Any questions here?
So here is the writer will get into this if he thinks that the prices will go up, and the holder will get into this if they think the prices will come
down.
Okay.
Correct. Yes. It's from the holder side anyway, but yes, to find a writer, the writer has to think the opposite side. So the writer will get into it if he thinks that the prices are going to go up, although he's not going to make any upside gains, at least he will keep that gain of $5 that he got. Holder will get into it thinking that the prices are going to come down because you have the option to sell and you're taking that option because you're scared prices might come down. Right. Yeah. Other questions? So the option writers can be speculators. They can be speculators. They can be dealers or bankers, right? So, and it doesn't matter, right? As long as you have opposing views, you can be an option writer. It doesn't necessarily mean, because it's a way for you to, now especially tomorrow, we look at option strategies. Option strategies mean, now these are the basic building blocks of the option. You have a call option, you have a put option, you have an option holder, you have an option writer. Okay. So option strategies are where you are going to mix and match them in different ways. So you are going to go hold a call option, write a put option, mix it together, or hold a call, hold a put, write a call, write a put, hold a call, go long on a share, write a put, whatever, right? So with all of these different variations, what are you going to do? These are called option strategies. We're going to create different strategies, right? So which, like protective puts, strategical scout calls, you don't need to know the names. You don't need to know the names, right? But what you do is to create certain situations, you mix and match the options in different ways. And when you mix and match the options in different ways, you create situations where you can gain with certain changes in stock prices, or certain, if stock prices come down, you can gain, or if stock prices go up a lot, you can gain, or if it doesn't go up a lot, you can gain, right? So for different ways of how the underlying asset is moving, not just stocks, underlying asset, whatever the underlying asset may be, depending on how the underlying asset is moving, you can look at trying to gain from those strategies. That is why even you can be an option writer. It doesn't necessarily have to be a bank. It can be a speculator. It can be a person who is actually a hedger who wants to. Now, for example, in the CPCD, we'll talk about it tomorrow. In the CPCD, CPC also wrote options. It is where they went wrong because of the way they wrote options. but they were option writers as well, not just option holders. So the way they combined it actually created a situation for them where they really made a lot of, they didn't come out well in that situation, right? But even hedgers can be option writers because it's a way for you to gain some additional returns. So we'll talk about that tomorrow. Okay, so tomorrow we'll look at how to combine these together, and we'll take it from there. Thank you. Let's start.
Thank you, madam.
Thanks a lot. See you.
Thank you, madam.
Thank you,
Thanks a
madam.
lot. See you.